Power isn't always visible, money isn't always loud, but there is one institution whose decisions can move trillions of dollars across the global economy, an institution that can make markets rise or collapse. That institution is the Federal Reserve, and most people don't truly understand how much power it has. In this video, we're going to break down how the Federal Reserve really controls financial markets. The Federal Reserve, often called the Fed, is the central bank of the United States. It was created in 1913 after a series of financial crises that shook the American banking system. Its official mission sounds simple: maintain stable prices, maximize employment, and keep the financial system stable. But behind those simple goals lies enormous influence. The Fed controls the supply of money and the cost of borrowing across the entire economy. And when you control money, you control almost everything. From mortgages to stock markets, the Fed's decisions ripple through the entire financial system. But how exactly does it do that? One of the most powerful tools the Federal Reserve has is interest rates. Interest rates determine how expensive it is to borrow money. When the Fed lowers interest rates, borrowing becomes cheaper. Businesses borrow more money to expand. People take out loans to buy houses and cars. Investors pour money into stocks. As a result, the economy speeds up and markets often rise. But when the Fed raises interest rates, the opposite happens. Borrowing becomes expensive. Businesses slow down spending. Investors become cautious and markets often fall. This single lever, raising or lowering interest rates, can shift trillions of dollars across global markets. But interest rates are only the beginning. Another powerful tool the Federal Reserve uses is called quantitative easing. This is often described as money printing, but it's not quite as simple as printing physical cash. Instead, the Fed creates digital money and uses it to buy financial assets like government bonds. When the Fed buys these assets, it injects liquidity into the financial system. Banks suddenly have more money to lend. Investors have more cash to deploy, and markets often surge. This is exactly what happened during the 2008 financial crisis and again during the 2020 pandemic crash. Trillions of dollars were injected into the financial system, and markets recovered at record speed. But this kind of intervention also raises an important question. What happens when the Fed stops? Financial markets run on something called liquidity. Liquidity simply means how easily money can move through the system. When liquidity is high, money flows freely. Investors buy assets, companies raise capital, markets remain stable. But when liquidity disappears, markets can freeze. Selling accelerates. Prices collapse and panic spreads quickly. Because the Federal Reserve controls liquidity through interest rates and asset purchases, it effectively controls the fuel of financial markets. And when that fuel runs low, markets feel it immediately. Every time the Federal Reserve makes an announcement, global markets react instantly. Stocks move, bond yields shift, currencies fluctuate. Why? Because investors know that the Fed's decisions shape the future of the economy. If the Fed signals lower rates, markets often rally. If the Fed warns about inflation and raises rates, markets often fall. Even a few words from the Fed chair can trigger billions of dollars in trading. In many ways, the Federal Reserve has become the most powerful economic signal in the world. But its influence doesn't stop at the United States. Because the US dollar is the world's primary reserve currency, the Fed's policies affect economies everywhere. When the Federal Reserve changes interest rates, the impact spreads across the entire planet. Emerging markets feel the pressure. Global investors shift capital between countries. Currencies rise and fall. And governments around the world adjust their policies in response. This means decisions made in Washington can affect businesses and economies thousands of miles away. Very few institutions have that level of global influence. The Federal Reserve doesn't control markets directly. It doesn't pick which stocks rise or fall. But by controlling interest rates, liquidity, and money supply, it shapes the environment in which markets operate. And in that environment, trillions of dollars move every single day. Understanding the Federal Reserve isn't just about economics. It's about understanding the system that quietly drives the modern financial world. Because in finance, the most powerful forces are often the ones you can't see.